Hey everyone, welcome back to Corporate Decoder, the place where we unravel the secrets hidden in plain sight within company filings. And today we're diving into some serious debt maneuvers that might make you wonder if these guys are borrowing from Peter to pay Paul, or just smartly planning for the future. Before we start, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below where we dive deeper into these topics. Alright, so what we have here is a current report, an 8K filing. That signals a pretty significant event for MGE Incorporated and its subsidiary Madison Gas and Electric Company, or MGE. This is T about year, end results or quarterly performance, but rather about a specific material agreement they've entered into. The core of this filing is about MGE creating a new direct financial obligation. Basically, they're taking on new debt. On the 14th of October 2025, MGE signed a note purchase agreement to issue two types of senior notes. This is T like getting a loan from a bank. It is more like selling IS to investors. This agreement involves Madison Gas and Electric Company issuing $25 million of its 5.12% senior notes, Series A, which are set to mature in November 2036. That is a long time away, over a decade. On top of that, they're issuing another $25 million of 5.76% senior notes, Series B, which have a much longer maturity date, all the way in November 2055. We're talking about almost 30 years here. So, in total, MGE is committing to borrow $50 million. The actual sale and issuance of these notes are expected to happen on the 13th of November 2025, assuming everything goes smoothly with the standard closing conditions. Now, why would a company take on this much debt? They state pretty clearly that the money from selling these notes will be used for capital expenditures and other corporate needs. Capital expenditures, or CapEx, generally means investing in long-term assets like property, plants, and equipment. For an energy company like MGE, this could mean building new power generation facilities, upgrading their existing infrastructure, or investing in renewable energy projects. Let's break down the cost of this borrowing. The series of notes, the ones maturing in 2036, will come with a 5.12% annual interest rate. The Series B notes, the ones that go out to 2055, will have a slightly higher interest rate of 5.76% per year. Both sets of notes will require interest payments twice a year, in May and November, starting in May of 2026. Here is where it gets a bit interesting with the redemption clauses. MGE can choose to pay back these notes early at any time. However, if they do, they have to pay back the principal amount plus any accrued interest, and also a make-whole premium. Think of this premium as compensation to the note holders for not receiving the full interest payments they expected over the original term of the note. It's essentially a penalty for early repayment, though it is not charged in the final months leading up to maturity for either note series. There is also a provision for what happens if there is a change in control event. If this happens, MGE will have to offer to pay off the notes early. A change in control is defined in a way that's tied to their credit rating. If MGS senior unsecured long-term debt doesn't have an investment grade rating from at least two of the major rating agencies after someone acquires a significant stake in the parent company, MGE Energy, then this change in control event is triggered. This suggests the company is keenly aware of how market perception and financial health can impact its borrowing costs and obligations. The agreement also comes with financial covenants, which are essentially rules MGE has to follow. One key rule is that their consolidated debt must not exceed 65% of their consolidated total capitalization. Capitalization is basically the total of a company's debt and equity. This is a pretty standard limit to ensure a company doesn't become overly leveraged, meaning it doesn't borrow too much relative to its overall financial structure. They also get to exclude certain items from these calculations, specifically those related to variable interest entities, which is a fancy accounting term for specific types of subsidiary structures. Another significant restriction is on priority debt. MGE is limited to issuing such debt, which is essentially debt secured by liens or certain unsecured subsidiary debt, to no more than 20% of its total consolidated assets. This is a measure to protect the holders of these new notes, making sure that other creditors don't get ahead of them in line for repayment if things go south. They also can use this limited capacity to secure their main credit facility debt without giving these new notes equal security. So, to wrap up this part, MGE is bringing in $50 million by taking on long-term debt with varying interest rates and mature dates, with specific conditions and restrictions to protect the lenders. It is a substantial amount, and the long maturity dates suggest they are planning for long-term investments and possibly refinancing other existing debt. Now, looking at these numbers and this strategy more broadly, MG Energy and its subsidiary Madison Gas and Electric operate in a stable, regulated utility market. Their business is about providing essential services, which generally leads to predictable revenue streams. This issuance of long-term debt is a common tool for utility companies to finance significant capital projects that are necessary for maintaining and upgrading their service infrastructure and complying with environmental regulations. The fact that Series B debt goes out to 2055 indicates management's belief in the long-term stability of their operations and their ability to service this debt over a very extended period. However, taking on $50 million in new debt, especially at rates ranging from 5.12 to 5.76%, does increase the company's financial leverage. While the 65% debt to capitalization limit is a common safeguard, it's something to keep an eye on. If their earnings were to falter, or if interest rates were to rise significantly from current levels, though these rates are fixed, servicing this debt could become more challenging. The make-whole premium, while protecting the company from unfavorable early repayment scenarios, also adds a cost if market conditions change and they want to refinance under better terms. The risk factor related to a change in control event. Tied to credit ratings is also noteworthy. It implies that the company is mindful of its creditworthiness and the market's perception of its financial stability, especially in the context of potential ownership changes or significant shifts in its business or regulatory environment. Overall, MGE appears to be strategically financing its future growth and infrastructure needs. The long maturity dates suggest confidence in their long-term business model. The primary risks involve the increased debt burden and the potential for interest rate fluctuations, though these specific notes have fixed rates. The credit rating trigger for accelerated repayment also highlights the importance of consistently strong financial performance and market confidence. Investors would want to see how these new funds are deployed and if they lead to the expected increases in operational efficiency or revenue generation through their capital projects. Alright, that is our breakdown of MGE's latest filing. What is your take on these numbers and what they signal for the company? As future, do you think taking on this much long-term debt is a smart move? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.